So we're keeping things moving today. So you'll notice I have not been out to introduce any of the panels. That way we just keep it flowing. I made an exception for this next one, not just because it's a very, very dear friend of mine, but because I'm a risk taker. I'm an adrenaline junkie. And the single most dangerous place to be is standing between Anthony Scaramucci and a stage or a camera. So we're going to bring it on. So we have a fantastic presentation setup. So we have, in addition to Anthony, we've got Caroline Pham, acting chairman of the CFTC, MC Lader, who's the president and chief operating officer at Uniswap Labs, and Dave Olsen, who's the president and CIO at Jump Trading. Now, I was around when electronic trading and high frequency started. I was chatting with Dave backstage. It wasn't that long ago when exchanges were wrapping LAN cable around their arm to simulate a second of latency. I'm not talking about 1960. That was happening in 2002, 2004. Some of you in the audience know that. And we've just come so far. So we have this next generation of derivatives and online trading quickly becoming the next frontier of financial innovation. So this panel brings together the top voices around both trading, protocol development, all operating under the world's most trusted regulatory regime, thanks to incredible regulators like Caroline Pham. We're going to explore how on-chain derivatives are reshaping market structure, deepening liquidity, and accelerating institutional engagement. So please welcome our next panel.
Guys, let's get started. Good morning, everybody. MC, I'm going to start with you, if you don't mind.
Sure.
The shift in the regulatory environment, how do you expect DeFi and the crypto derivatives markets, how will they evolve over the next 12 months?
I think the next 12 months are going to be the most growth in DeFi that we've seen since 2021. I think we're poised for breakout in the number of users, the kinds of users, more sophisticated and institutional users, as well as more and more retail. And a lot of this is because blockchains have scaled a lot in the past couple of years of the bear market. They're cheaper, they're faster, there's more assets, there's more to do, there's more flexibility in market structure. That's in part because of the derivatives protocols that exist in DeFi, but also because of a protocol like Uniswap that now lets you program market structure at the protocol level. So all of that together means that there's a lot more to trade, there's a lot more opportunity for a lot of different categories of users, and I think this is going to be one of the most interesting years yet. And as you said, all of that's unlocked because of the massive shift in the regulatory treatment and tenor.
Caroline, you got a huge job, Caroline. You're right there at the intersection of all the innovation, but you've got to be super worried about risk management. How do you handle all that? What are your thoughts on the future? And how are we going to get there together?
Yeah, absolutely. So I love this question because it is embedded in the CFTC statutory mandate that we're here to promote responsible innovation, as you mentioned, but also to promote competition. There's a balance, and you can always balance that out. What I love about what we're seeing in the United States is a complete reset on the approach to crypto and new technologies and innovation in market structure. We've been focused on that at the CFTC, and I think when you overall consider what are the conditions necessary to promote innovation in any country or any jurisdiction around the world, you're talking about the rule of law, political stability, and regulatory clarity. And regulatory clarity is what we've been delivering on since January. So it's not just ending regulation by enforcement, which I've been so pleased to really lead the charge on that, but it's also rescinding advisories that unnecessarily penalized crypto as an asset class. And then it's also being forward-looking and having the President's Working Group report on digital asset markets that's going to be coming out next month. Really excited about that. It's going to bring a lot of clarity to the United States about where things are vis-a-vis the SEC and the CFTC. But I think the key aspect that we have to remember is that when we talk about crypto, we're talking about so many different things. First of all, when we talk about crypto as an asset class, that's where we really need to have the regulatory clarity to make sure that this asset class isn't unduly penalized vis-a-vis any other asset class rates, commodities, FX, physicals, whatever it might be. The other aspect, which is just tokenization of financial instruments, I mean, Citi and McKinsey have estimated the total addressable market could be 2 to 5 trillion by 2030. That's the same activity, the same risk, and the same regulations. I actually don't really think there are any changes necessary except for some, technical application of some specific aspects, maybe record keeping. Obviously, a lot to clarify in the custody space just about the SEC's customer protection rule. But those things can all be addressed. There have been white papers about this that I participated in when I was at Citi back in 2019. So these are all easily solvable, and the SEC is moving ahead very clearly to fix all of those issues and to provide that clarity that's necessary. And then the last piece, which I think is the most important piece for what MC was talking about for the future of DeFi, is that we need to have a technology neutral approach. The CFTC has historically always had a technology neutral approach. Why would we do this any differently than when we went from paper stock certificates to electronic records to maybe now records being on a blockchain? We shouldn't be impeding the technology by having something that is treating blockchain different from any other technological innovation.
David?
Anthony?
How are we going to improve the interoperability between the DeFi platforms and TradeFi, and how are we going to make this easy for institutions?
Yeah, we'd love to see it get easier. We're trading everywhere we can. We kind of go where the market is at our company. And right now, we're not really able to trade on DEXs for the most part. We've got a couple of impediments in our way. A lot of those are being worked on right now. But without the platforms developing and the regulatory wrappers around those platforms giving us certainty that we're not facing off against someone who is in a jurisdiction that we can't trade or changes the nature of the way we trade or is on a sanctioned list, we've got to stay away. We're trying to stick with both the letter and the spirit of the rules that govern our trading. I'll point out, though, that's a US condition for the most part. We've got more clarity to trade from our offshore entities on offshore platforms with non-US persons where we do have a lot of integrity of that chain. So the first step is regulatory work, but then there's some plumbing that we've got to get after to really make interoperable what's happening on chain and in the crypto derivatives market with traditional markets. You've got a disconnect with the decades-long development of the prime brokerage model and the clearing model in traditional products, where two really important things happen. One, we can net longs and sells and not have to gross settle, $10 million there and negative $10 million there. It takes a lot of capital and would remove a lot of fluidity from the system. And the second thing is financing and having a risk intermediary that can tie all those together. We can do that ourselves, but without being able to collapse the longs and the shorts and really trade both fluidly, you're going to have them stick in their own silos for a little while longer.
Go ahead.
Yeah, I just want to jump in on the accessibility and the barriers to using DEXs, because a lot of what Dave's talking about is specific to derivatives. There are, as many people in this room probably know and use, there are compliance solutions and filtering that allows you to use a DEX and then have an interface that helps you block sanctioned actors. So I think that these tools exist, and they sort of an institution or organization by organization task to integrate them in your trading and your workflow, and that plumbing isn't necessarily that sexy, but that's happening rapidly. So Uniswap launched an API that integrates with TRM and one of these compliance solutions that helps you sort of screen out wallets that have been associated with illicit activity, sanctions, hacks. And so institutions can use the Uniswap protocol integrated through that API and have that kind of comfort. That plus then having spot derivatives and lending kind of integrated in the overall trading workflows, I think the last piece that Dave's talking about, but that's all happening now.
I think we also need to be thinking more creatively about enabling more flexible methods of execution in derivatives markets. So when swap execution facilities were created in Dodd-Frank, the idea was that this was going to capture the existing interdealer broker model, and that we were going to just create more risk management and other types of controls around it. But what actually happened was that, I think some of the unfortunate consequences of Dodd-Frank was, number one, it created these regulatory moats, incredible barriers to entry, and number two, market fragmentation. And the CEF framework actually was a huge part of contributing to that market fragmentation and the fracturing of liquidity from the US and non-US markets. And then over time, the CFTC staff have done these interpretations where they've really tried to force swap execution facilities into an exchange central limit order book model. And the fact is that for derivatives, particularly for ones with like less liquidity or you want to be more bespoke with your tenors and things like that, you should have more flexibility. So I would be very interested, and I've proposed in the past, that we should look at something that is like an ATS, but under the derivatives framework, permissible in our rules. That's going to enable, I think, a lot of the innovation in the DEX space.
So I think the administration has done a great job in this area, and I think the president was right that there was a war on this industry from the prior administration. So Dave, the question is, if you were the regulatory czar, what would you want more of? What is the administration doing right now that you would want to encourage? And what are the things that you would like to discourage?
I think, first off, it's clarity. Thinking back to the Dodd-Frank days, I think some of the initial proposals for how to trade credit derivatives were, the intention of the trader. I think Jamie Dimon back then said he's going to have a lawyer and a psychiatrist sit next to every trading seat to figure out what was in that trader's head when that trade got put on. In thinking about securities-based swaps, the definition there is if it's a narrow index, it's less than 10 components, and that's a security. If it's 10 or more, that's an index, and that is a derivative. I don't know if that's right or wrong, but it's super clear. Like, you know exactly what you're trading in securities-based swaps or swaps land today. So I think rules that are not subject to interpretation is a big one. Also, I think the speech that SEC Chair Atkins gave earlier this week talking about an innovation exemption so that we can try new models in the US and not have a scenario where 4, 6, 7 years later, a new regime looks back and says, our interpretation of what was happening then is that ran afoul of the rules, even though you had private conversations at the time saying it was okay. There are a few specific areas that around whether crypto are defined as securities or not that we think are vitally important. That's the number one issue in front of regulators and legislators right now that I think the industry wants to see most. It's just clarity on that front.
So let me turn to Caroline for a second and just ask, how do we make this bipartisan? Meaning, how do we, in a subsequent administration from the Trump administration, have the clarity that's being defined by Dave and others solidified?
So if we come back to what ought to be our first principles, what is best for the market and for market participants, that's not a political question. That's a question of liquidity. It's a question of risk management. It's a question of ensuring that markets are resilient. And politics should have nothing to do with that. So I think that's first and foremost is we have to understand what are we here for. We're here to ensure that we have market integrity, that we have liquid, well-functioning markets that are resilient and that can recover through times of stress, market dislocation, those types of things. That's what I've been talking about when I keep saying that the CFTC has to get back to basics. That's what the CFTC used to be about until crypto became this battle between good and evil over the last 4 years. And there was this targeted effort to really go after the crypto industry and to stamp it out, right? And that's wrong. Who are we to judge a technology and say whether or not it's good or evil? Technology is neither. So I think getting back to basics and coming back to those first principles about what's good for the markets, and then it's very straightforward, right? You need to look at your financial and your non-financial risks. I love what Dave is talking about, and this is something that I've discussed with Chairman Atkins and with others at the SEC for a long time. In March, I proposed in an op-ed in International Banker that we need to be using our exemptive relief to provide the regulatory clarity today, because even when legislation passes, there's going to be this period of time between when the legislation is in effect and when the rules actually get written. It took 4 to 5 years for the CFTC to write the bulk of the Dodd-Frank rules. It took the SEC 12 before they did the rules for security-based swaps. So what are we going to do in the meantime? I think time is money. There's a regulatory burn rate. It's very real. We are behind the rest of the world because I've been working on regulatory clarity for digital assets since 2017, 2018 in jurisdictions all around the world before I became a commissioner at the CFTC. So we can use today, under our existing authorities, the same exemptive relief powers that created the framework for security futures between the SEC and the CFTC, and those trade today, and they're liquid, and they're on SEC exchanges. And broker-dealers engage in them. We can also do the same thing we did for OTC derivatives way back in the 90s. That was also through our exemptive relief powers. And then we had the legislation come in and really codify and clarify those approaches. But that's how we do experimentation in the United States. That's why I proposed in 2023 a regulatory sandbox to use our abilities to create a pilot program. The SEC's done that many times. The CFTC's been doing that since the 90s, like I said. So we need to use all the tools that are available to us today. There's no silver bullet. We just need to start getting down to work.
I want to give an example of why that durability is so important, and having a bipartisan solution to the regulation of crypto markets is an imperative. We trade a lot. We can be nimble trading. If there's a rule change or an enforcement action or something that changes the way we perceive the market structure to work, over a weekend, we can and have offshore our talent. We take them out of Chicago and we put them in London or the Cayman Islands or something like that to make sure that we're adhering with the rules. Trading is ephemeral in a lot of cases. Another part of our business that I think is a little less well known is we're builders. We build ambitious blockchain engineering products. Some of you may have heard of Pith or Wormhole or the Fire Dancer acceleration of the Solana validators. These are years-long development efforts where we take top talent from within Jump that's working on some problem that we're trying to solve, and we try to direct that toward open source code that goes into the crypto community that can make DeFi stronger, risk-taking more effective, whatever. You can't, it's a little bit like a factory. If you don't have a vision that 3 years from now, when this product is finally going to reach the market, that it's going to be allowed to, you don't even start today. So I think trading, if things whipsaw and this is viewed as a partisan result, we're going to be left in the meme coin kind of world of crypto. Mm-hmm. If we're allowed to really build and think about this as the same way we think about a chips factory in Ohio, this is a virtual factory where US engineering talent is building new solutions, and we can see far enough on the horizon to redeploy those. That's where you're going to see a lot of the unlock for what crypto can do in financial markets.
Right.
Do you want to add something, MC?
Yeah, I think that part of what Dave's talking about is it's just an example of the power of having an open financial services technology stack that you can have Uniswap build stuff that anyone in the world can build on top of, that Dave, Jump, others can start to customize. So I think that means that we're going to see on-chain trading and DeFi be a lot more flexible because there are that many more participants who can start to adjust basically market structure. It used to be for the past few years that DeFi was essentially one market structure. A given DEX was one market structure. And now because of so many different participants have developed their own technical capabilities, they're doing their own engineering, you can at an individual pool level or pair trading level start to set your own customization and parameters. And so that means it's just a lot more, there's a lot more that you can do, and I think that's going to start happening this year.
Yeah. So I want to just follow up with you for a second, MC, and just because you and I have been in more than one meeting in Washington. Mm-hmm. And particularly last summer, I would say the Washington atmosphere was quite frigid. Tell us about your view of Washington today versus where we were a year ago.
Yeah, I think you're referring to the call that we were on where we were asked how many of us had been debanked, and we all raised our hands. It was memorable. Yeah, look, it's a totally different tone, I think. We've all experienced that. So, we were debanked multiple times and had spent $20 million handing over legal documents to the SEC to never even get sued because we weren't breaking the law. And this year, in 2025, I think there's like 2 to 3 elected officials who find their way to our New York City-based office every week. So there's the level of interest is really, really high. I'm really excited and optimistic about market structure legislation, but it's very detail-oriented, and it's being shaped or written on the basis of what exists today in crypto. And this technology can evolve so much. So I just hope that we have more principles-based legislation because the technology is going to continue to evolve, and we want to make sure that the U.S. can continue to lead and not be too specific so that things then ultimately get outcompeted.
Yeah, and a lot of this is not, it's not unknown, right? It's not like we never know how to regulate anything. It's not like the whole world hasn't been trying to figure this out, like I said, for almost the last 10 years. You know, I started looking at the regulation of Bitcoin and crypto in 2013 when I was at the CFTC. So in 2022, I proposed 10 fundamentals for responsible digital asset markets. It's a great blueprint because fundamentally, you either regulate one of two ways. You either regulate the entity that is doing the activity, or you regulate the activity itself. So we do both models in the United States. For banks and other types of financial institutions, we regulate primarily that entity and then the things that that entity can do. And then for the SEC and the CFTC, we regulate the activity, trading of securities, trading of derivatives, and then the entities that do it. So it's like the same, but it's different. It's a slightly different way of coming at it. And so that's why it's so important to get that clarity around what's a security and what's a commodity. But also, in the past, the SEC and the CFTC haven't even really had to answer that question all the time. In fact, like for security futures, we never really said which one of us has the jurisdiction. We just said, you know what, it's okay for you to do it on securities exchanges and to do it on broker-dealers, and that's fine, and the CFTC is not going to get involved in that. And it allowed for people to really use those instruments to hedge more efficiently, to be more capital efficient, to be able to net and to margin and all of those things that are important, again, about having resilient markets, which at the end of the day is what we should be focused on. For banks, if we say banks, you know, that's actually how it is currently, right? As long as banks appropriately have risk governance frameworks and manage the risks of the activities that they're engaged in, it doesn't really matter the technology. That's why banks have been using AI for over 10 years, right? That's why banks have been using blockchain technology. Even during the Biden administration, banks were using blockchain technology. So if DeFi is not a dirty word, so long as you have the appropriate risk governance frameworks over your deployment of any technology, it's fine. And so I think it's really important that we get to that next level where we stop targeting the technology and we talk more about how do people use it, and are you using it responsibly?
It's a good segue because let's talk about TradeFi for a second, Dave. What can we learn from like the derivative markets and TradeFi that can be applied to the new DeFi markets?
Yeah, for me, the first lesson is in almost every case in traditional assets, the derivatives markets grow to be many multiples the size of the cash market. There's just more efficiency. There is the ability to customize the risk profile that you want to trade. There's embedded leverage if you need it. There are a whole variety of reasons why derivatives are seen as a more attractive solution to the market than the cash asset. That's already happened in crypto. It just hasn't happened in the US. So if you look at the map of where risk is taken in crypto, it's in perps. Perps are the instrument that this market wants to trade globally, and the volumes on Binance and OKX and Bybit and all the other offshore platforms absolutely dwarf what feels like the biggest place to trade crypto in the United States is the sponsor today, Coinbase. And they're making strides in derivatives, but I think that the lesson is you've got to have a global framework that allows fluid interaction of risk on offshore and onshore exchanges to let that really flourish.
Go ahead.
Yeah, and then the last point I'll make is that until it's clear and the ink is actually dry on the regulation, that's when the intermediaries are going to be comfortable coming in. They're not going to come in on vibes. Even if the vibes are good, you need to see the legal framework that you can point to, and where either in regulation or exemption, you've got a path to provide that capability. Yeah. Important lessons.
Yeah, and I love that you're talking about perps because I need to address some fake news. Perps have been live in the United States in CFTC markets on our futures exchanges since April. We're not waiting for perps to go live. They've been live. They've been live on Binomial. They have the Centi futures. And they worked with the CFTC and our staff for over a year on what was the methodology, what was the pricing, what was the funding, you know, how are they calculating that when it's like a rolling future, but it's not actually a rolling future. So these are things that we've been working on. These are things that are well known. There are a number of other CFTC registered exchanges that have self-certified additional perps. They all have kind of different, again, methodologies and pricing and funding. But it's thriving. And it's thriving because of the fact that we have this principles-based regulatory framework. It works for listed derivatives. It's worked for listed derivatives for, even before the CFTC existed as an agency in 1975. So I think people are overcomplicating what is pretty straightforward just because it's a different asset class. But we don't, freak out over metals or energy or ags or interest rates or FX, all of these different asset classes that are traded in our market. So I just don't know why everybody is like, oh my God, we have to reinvent the wheel for crypto.
You want to add to that, MC?
No, I agree. I agree with what you said.
So let's shift topics for a second. It's just something I want to get your editorial, and I'll ask all of you the same question. Start with you, MC. What has to happen? Let's talk about the next 3 to 5 years. What has to happen for this market? Jeremy and Brian said earlier today that we're so early. So what are some of the things that have to happen? So for me, I'll go first and say that the money center banks have to get more involved, and there'll have to come a day where I can custody my Bitcoin at a large money center bank, and I say that the market is reaching some level of maturity. In your opinion, MC, what would that be?
Well, part of the promise of why we all think this could be the foundation of the world's financial system is because we think global 24/7 markets that can be faster and cheaper and natively digital are better. But blockchains haven't necessarily been faster and cheaper. And so I think that has to continue to improve. And Coinbase and Uniswap are doing a lot of work to try and make blockchains faster and cheaper. We also just need more assets. There need to be more assets that people want to trade, that retail wants to buy and trust to hold, and that institutions find compelling and think that they can profit from. So that, I think there's a lot of product challenges and sort of operational friction that Dave talked about to make it such that this ability to create a token, create a market, add liquidity, trade yourself, hold your assets yourself, all that's possible today, but you have to have a lot of know-how and you have to have a lot of translation to be able to do that. So I think those are just product and user experience challenges. But I think that they're all starting to happen. And in the background, of course, is the regulatory clarity that we've been talking about. But I'm continuing to be optimistic that this will be led by many different countries, like the adoption from retail users around the world, who I think are going to be excited about some of the tokenized equities that are coming in this summer. That's an example that doesn't really solve a TradFi challenge, doesn't really solve a TradFi or market structure challenge, but it's an example of access and the potential of global 24/7 markets.
Great. Caroline, same question.
So I love the part about money center banks because I used to work in a money center bank. And it is all contingent on the banking regulators. The banking regulators aren't even part of the president's working group on digital asset markets, but it's the banks that are the biggest dealers in the world in swaps in our derivatives markets. So to me, this has already been happening since January. It's just that, the world of banking and bank regulation is typically not something that is on the front page that is immediately accessible. It's rather esoteric. But here's the thing. The acting controller of the currency, Rodney Hood, a dear friend of mine, he has already said that banks can custody digital assets. He has already withdrawn the letters, as well as the other bank regulators, that prohibited banks from engaging in digital asset activities without getting a letter of non-objection from the bank regulators. The infamous SAB 121, which I think the SEC forgot that banks are public companies and that banks custody things. So, clearly getting that rescinded by acting chairman Uyeda on the second day, I think, in office was huge. So banks can do these activities. Of course, JP Morgan has been very active in the digital asset space, as has BNY, as has Citi and all the other banks. It's been quiet. Now I think you're going to be able to see them really accelerate. So all of these projects that everybody's been working on since 2016, now we're going to start seeing more deployment, more volume, and so on and so forth. And a lot of it's been done, frankly, through portfolio companies and strategic equity investments, and so you'll see that deployment. But it's really the bank regulators and making sure, again, that the bank regulators are comfortable with the banks, with their risk governance frameworks, and then a lot's going to start to happen.
As a banking alumnus, I also agree. You hear a lot of talk about where's the institutional trade, what's the mix of retail institutional. I'm I view a little bit different lens on participation in the market. And the group that is underserved, in my opinion at the moment, is third-party asset management. When you hire a portfolio manager and you make an investment, whether you're an individual or an insurance company or whomever, and that money manager says, okay, I'm going to have 4% of this portfolio in crypto, that is the switch that hasn't flipped yet in this market. It's primarily people that own the assets or have control over the institution to an extent where it's more or less the same thing. So retail, they own the asset, they're going in. Founder-led companies that are putting crypto on the balance sheet, same thing. It's effectively first-party, first-order money management. So getting third-party money managers comfortable enough to have a portfolio construction that includes crypto is an inflection point that we haven't seen in the market yet. Part of that's going to be bank involvement to provide the services to those folks and the relief that they can get so that it's permissible for them, whether it's custody or best execution or what the other variables are.
Okay, so we got about a minute left. So this is a 20-second question for each of you. What is an observation that you'd like to share with the audience that you've learned recently about the space? So I'll go quickly and say the number of FAs that are now contemplating putting at least 1% of their client's portfolio into crypto is up exponentially in the last 6 months. MC.
Yeah, I'd say the number of like asset issuers who are looking to launch like an on-chain asset is also exponentially increased in the last like 3 months, 6 months, 12 months. Yeah.
Caroline.
So everybody asks me, how do we prevent regulation from enforcement from happening again? How do we prevent the criminalization of a technology? And I've been telling everybody, you have to Uberize it. You have to massively scale it so that way it becomes politically untenable to take it away from people. Look at TikTok. They couldn't take TikTok away from people. You couldn't take Uber away from people, and Uber had violated a lot of laws when it first came out. The thing is that the last administration ignored the laws that were on the books and ignored the rules that were on the books. So it has to be something else, a Bitcoin in every brokerage account.
Good.
For me, it's the emergence of on-chain execution this year. Hyperliquid's turning a lot of heads. They're the first meaningful competitor to Binance. They're exposing some of the gaps in the regulatory framework to have US participation, but that story's got legs.
Guys, thank you very much. Great panel. Ladies and gentlemen, thank you guys.